As Nigeria Central Bank prepares for the crucial November Monetary Policy Committee meeting, all eyes are on the indicators shaping the country's economic direction. With inflation still elevated, exchange rate pressures lingering, and global financial conditions tightening, the stakes have never been higher. Now, today we explore the projections, the key issues on the table, and what policymakers are likely to consider as they weigh the next steps for interest rates, liquidity, and economic stability. I have with me the Chief Executive Officer of the Center for Promotion of Private Enterprises, Mr. Muda, Dr. Muda Yusuf. Thank you so much for joining us at this time.
Thank you very much. Good afternoon.
Good afternoon. All right, so what, in your view, are the most critical economic signals the MPC will be watching closely going into a November meeting?
Well, typically, the central bank governor has repeatedly said at his monetary policy committee meetings that the primary objective of the central bank is price stability. And in one of the, press briefings and communication, he emphasized the fact that they were adopting inflation targeting. So at the heart of whatever decision the CBN will take, as far as the monetary policy direction is concerned, is the inflation situation. And the good news is that the inflation numbers have been doing very well. It has been decelerating since the beginning of the year, except for 1 month. We have seen consistent trend of disinflation. In other words, reduction in the inflation rate. And alongside that, we have been seeing consistent stability and even some marginal appreciation in the exchange rate. These two key indicators are extremely very important determinants of the direction of monetary policy. And given where these indicators are, and given the trend since the beginning of the year, my expectation is that there is likely to be a further marginal cut in rates in order to be consistent with the signaling, that the central bank had commenced at its last policy committee meeting.
So you are optimistic that there will be a consistent decline of inflation?
Yeah, that is what the trend is showing. And the fundamentals also support that. Because one of the major drivers of inflation is the exchange rate. And because we have seen a very strong correlation between exchange rate and inflation. Now that we have had this incredible stability in exchange rates, and we're even experiencing some marginal appreciation, the probability is extremely very high that the inflation situation is not likely to deteriorate, at least in the short term, and possibly to the medium term, unless there's a major disruption, in the economy, which we don't, foresee. And in addition to that is the fact that we now have a very robust reserve. I'm talking of external reserve now, because the whole essence of the reserve is to be able to support the currency. And we have never had it so good, at least in the last 3, 4, 5 years. We have never had a reserve buffer as high as what we currently have. So given all of these fundamentals, the expectation is that the inflation situation is not likely to deteriorate, any further. If anything, it's likely to continue to improve. And we have been seeing the numbers. Now, from September to the October numbers, we have seen a sharp drop from 18% to 16%, almost 200 basis points drop in inflation, which is very good.
Okay, so what?
The only challenge, again, that is what the citizens have been saying, that they want to see a lot more impact.
That's where I was heading towards, where this can be very good on paper, but in the downstream with the people, the market woman, the carpenter, the bus conductor and all of that. How will this impact on the economies there?
No, the point is that already we are beginning to see some impact, because we cannot compare the prices of goods and services today with the prices of goods and services this time last year. Obviously, apart from all this academic discussion about inflation, there has been instances of drop in prices. I mean, the bag of rice that we were buying for 120,000 naira this time last year, we are now buying it for around 70. You know, in some instances, even 60,000. In some instances, even less than that. You know, and again, so quite a number of agricultural products, food items, their prices have dropped, but not sharp enough for people to begin to celebrate. But what we are seeing is that the prices are dropping. And in fact, even for manufactured goods, because of the situation with the exchange rates, because of the stability, because of the confidence level that has increased, because of the growing reserves, we're also beginning to see some impacts on imported inflation. Manufactured products are also, you know, as the prices of some of them are also dropping. I mean, there was an instance of some of these people that use Okada for business who was saying that the Okada that they used to buy at 1.2 million, 1.3, they were able to buy it for 800,000, 900,000. You know, so these are evidence of the phenomenon of deflation, because there's a distinction between disinflation and deflation. Deflation is price reduction. Disinflation is reduction in the rate of increase in prices. So the elements of deflation are, although not, you know, wide-ranging enough, which is an indication there's still a lot of work to be done. And if you look at even the last inflation numbers for October, we also saw that there was even an increase in headline inflation month on month, even though the headline inflation dropped from 18 to 16%, but on month basis, there was a slight increase. So that's an indication that we still have a lot of work to do. But the good news is that we are heading in the right direction. And I must also say that when we look at the key drivers of the last inflation numbers, they are things that are related to what we have just said. I'm talking about the basic things of life. They are things like food, transportation, energy, and some utilities we use in the house, education, and health. It is the prices in those categories of products and services that actually contributed about 84% of the inflationary pressure that we experienced in October. So the policy implication of that is that while we deal with the macroeconomic level issues on which we have made some, you know, remarkable progress, we should begin to zero in on these critical elements that are showing up in the inflation numbers, which are basically the basic things of life that are still, you know, driving the inflationary pressure. So this will require not just monetary policy, it will require a lot more of fiscal policy. It will require a lot more of targeted, product-specific, sector-specific policies to drive down prices. So I think that is the next level of policy that we should be looking at, so that the citizens and people on the street can relate a lot more and relate better to some of these inflation numbers that we are talking about.
All right, but in all you have said, we can still agree that Nigeria's growth momentum still remains fragile. Now, my question would be, how can the MPC balance the need to tame inflation but without stifling economic expansion?
Well, the growth numbers are not looking that bad. I mean, the last growth figure we had was 4.23%. That is not bad. When we compare it to what is happening even around the world, in the whole of Europe now, not many economies are doing up to 1% GDP growth. Here we are doing 4%. But again, the current trajectory of rate cuts is also to support growth. So that is the next level that even the monetary policy is going. Significant achievement has been recorded with respect to stability. The next phase of major focus in economic management is growth. And the trajectory of rate cuts is something that is intended to drive growth, to make credit, a lot more available. I mean, that is part of the objective. And it is also a good thing that the central bank at the last monetary policy committee meeting also tried to distinguish between the regular deposits and government deposits, so that we don't unduly squeeze or put businesses under pressure as far as credit is concerned. Because what we are seeing over time is that most of the liquidity in the system that the CBN is trying to mop up or to tighten, most of those liquidity are coming from the public sector, not so much from the private sector. So now that the CBN has separated public sector liquidity from deposits from the banks, I think that's a very good and very creative and innovative idea. So we now have a higher CRR, which is cash reserve ratio, of 75% for government deposits, and a slightly reduced CRR for the normal private sector deposits in the bank, which is a good thing. So taking all of these things together and taking all the efforts of the CBN to sanitize, the operations of the market itself, because those things are also important. The issues is not only about market, it's also about governance. Foreign exchange governance is also very, very important. So that all these elements of speculative people, money laundering issues, and so on, we can take that out of the equation. And that is part of the thing that has been, creating the kind of stability that we have. So I believe as far as growth is concerned, we are on course. But what is more important at this stage is to address the structural issues that are impeding our growth momentum. That's very key. And when I talk about structural issues, I'm talking about issues relating to regulatory environment, relating to infrastructure, relating to the ports, relating to logistics, things like that. Those things we need to step up our game as far as those structural issues are concerned.
How do we address these structural issues?
No, well, it's for government to undertake the right kind of reforms. First, if we are talking about infrastructure, you need to look at the budget, for instance. What percentage of the budget is committed to infrastructure development? That is critical. If you are talking of logistics, you need to look at the budget. How much of the budget is committed to that? I mean, look at what has happened to our budget. 2025 budget now has not, to all intents and purposes, has not even commenced implementation as far as the capital component is concerned. Those are part of structural issues. So it's a broad range of issues, but the whole thing about these structural elements is that they help to boost productivity in the economy. And without productivity, you cannot boost your output. You cannot grow the economy. So that is the significance of the structural component of this conversation.
All right, so let's go back in our discussion. How will the recent improvements in the FX market influence the committee's decision now, especially regarding liquidity and rates direction?
Well, it is positive, because one of the worries and concerns of the central bank over time is the stability of the exchange rate. Because when we are talking of prices, exchange rate is a very, very critical price in the economy. And the CBN, of course, has also repeatedly, acknowledged the fact that a lot of progress has been made as far as exchange rate stability is concerned. So the signaling coming from the exchange rate, I think, will give the CBN a lot of comfort, in the direction of ensuring that we cut rates. To also give the CBN assurance that significant, accomplishments have been recorded as far as stability is concerned. So this is the time to focus on growth. And for you to drive growth, you need funding. You can't be borrowing at 25, 30% to drive economic growth in an economy, because, what business are you going to do with that kind of funding? So with the stability in the exchange rates, and not just stability, even a moderate marginal appreciation of the exchange rate, with the deceleration in inflation rates, of course, all of these things put together point in the direction that, yes, we cannot begin to ease. And the CBN already has started that at the last MPC meeting. So I expect that trajectory should continue. It may not be that drastic, because the CBN is also very cautious. I know there are all sorts of variables, domestic variables, global variables that can distort projections. So I agree that we need to be cautious, but we need to be consistent in this signaling. And what I'm expecting is that, based on what is happening in the FX market, based on what is happening with the inflation rates, I expect that there should be some marginal cuts, especially in the MPR, maybe by 50 basis points or 25 basis points.
If the CBN have to go this direction, reduce the MPR by 50 or 25 basis points, what's the fate of lending, borrowing by SMEs or by businesses? How will this affect borrowing?
Well, the expectation is that, because, the MPR is also an indicative rate as far as inflation, as far as interest rate is concerned. So when interest rates are dropping, when the MPR is dropping, interest rates are also expected to drop. I think that has been the trajectory. So we expect a lowering of interest rates. But beyond that is to also ensure that, again, I go back to the structural issues. Because when you look at the disposition of the banks, especially, as it affects the SMEs are perceived as highly risky in terms of credit. And any sector that is regarded as risky is likely to attract a higher interest rate, what we call the risk premium, because the mortality rate of SMEs are very high. The mortality rate of those in the risk sector, or the risk premium in the risk sector, is also very high. So we need to do a lot more in the structural space to reduce the perception of risk, or even the reality of risk in the real sector of the economy. So again, this comes back to complementarity between the monetary policy and the fiscal policy. But the general thrust of direction of policy is that once MPR is dropping, it's a signaling that that interest rates should also be dropping. So that is what we expect. But we expect a lot more to happen in the structural environment, so that the risk of failure, the risk of default in credit, in the credit space, in loans and all of that, will be reduced, both within the SME space and within the real sector space. So that is how these things interconnect.
All right, to what extent will the ongoing fiscal reforms influence the MPC's decision this cycle? Is there better policy as alignment now?
Of course, the policy alignment has improved. That is why we are seeing these results. And the step taken by the central bank to increase CRR on government deposit to 75% is also central bank's way of dealing with the fiscal angle, or the fiscal perspective of liquidity. So the CBN also has used its own instrument to deal with liquidity effect of government spending by isolating the non-TSA government funds and slamming a 75% CRR on it. But generally, we have seen a lot of an improvement in coordination between fiscal and monetary, and that is why we are seeing the kind of results that we are seeing. But the only challenge, and we see how it goes, by first quarter of next year, with the tax reform, it is also likely that we have more government revenue. And what you have also noticed is that the higher the government revenue, the higher the liquidity injection into the system, the higher the risk these things poses, to macroeconomic stability. But when we get there, I'm sure the CBN will respond appropriately to it.
All right, so how is the current liquidity level in the banking sector likely to affect CBN's policy options here?
Well, to the extent that we have all these indicators looking very positive, it's an indication that liquidity management framework is much more effective than it used to be. We are seeing less of speculative tendencies in the economy. We are seeing less of speculative tendencies in the financial markets, including the forex market. And all of this is an indication that the framework for liquidity management is working well. And of course, the liquidity management instruments are also very flexible instruments. The MPR, the OMO, and the rest of it. As things develop, as some of those risks crystallizes, the CBN will, of course, respond appropriately to it. Because the CBN, the monetary policy instruments are a lot more flexible, unlike what you have in the fiscal policy space. So the CBN will respond appropriately to any risk to liquidity in the system. But so far, the instrument that have been used so far, I think is giving us some very good results, both within the pure financial market and within the foreign exchange market. Those instruments are giving results. So I think for now, there is no major concern about liquidity management issue in the banking system.
All right, so what kind of direction or reassurance should stakeholders expect from the MPC to guide economic decisions? And I will also ask about your projection heading into 2026.
Well, the assurance that the CBN has consistently given is that the CBN is committed to stability of prices. Stability of prices in the forex market, stability of prices in the general economic space. I'm talking now about inflation. And the CBN has consistently affirmed the fact that its primary mandate is price stability, and that it was committed to achieving those objectives. And as we get close to the end of the year, you can see that those objectives have been, significantly achieved. And if you look at the economic environment now, you cannot compare the general macroeconomic environment in 2025 to the macroeconomic environment in 2024. So there's a progressive improvement, which is an indication that these policy measures are working and moving in the right direction. That is not to diminish the fact that there's still a lot of work to do to bring down the cost of production and the cost of living. Because there are macroeconomic objectives, there are productivity objectives, and there are welfare objectives. We have to move from one to the other. We are achieving a lot now in the macroeconomic space, stability space. We should be talking of growth. We should be talking of welfare. We should be talking of productivity. That is the kind of progression that we should be, following through.
All right.
Both with the fiscal authorities and the monetary authorities. But generally, I believe we're on course.
All right, Chief Executive Officer of Center for Promotion of Private Enterprises, Dr. Muda Yusuf. Thank you so much for taking our time to dissect these issues. Thank you very much.
Thank you very much. Thank you.
Well, still to come on the show, challenges and prospects of small and medium enterprises in Q4 of 2025.